Okay, hi everyone. Let's tackle this problem. On December 30th, you made a $5,000 charitable donation. And the first question that we're asked, you can see it right here. It says, if you are in the 32% tax bracket, how much will you save in taxes for the current year? Now, you should assume your other itemized deductions exceed the standard deduction amount. All right, let's take a look at the solution, and I'll work this for you. Now, the tax savings are $1,600. Okay, so how would you calculate that? You would take the $5,000 charitable donation and multiply it by the tax rate. All right, if we wanted Excel to do the math for you, we'd put 5,000 in here. I've already formatted that cell. We'd put the tax bracket in here, which is 32%. Okay, and then we would just multiply the 5,000 times the 32%. Now you can see the formula here or up here. So we take the value in cell I8 times the value in I9, and we get the $1,600. So that's pretty straightforward. Now let's look at the second part. If you deposit that tax savings in a savings account for the next 6 years at 7%, what will be the future value of the account? And they say to use Exhibit 1A, which I have down below. Round your future value factor to 3 decimal places and round your answers to 2 decimal places. All right. Now, the answer comes out to be 2401.6. Okay. If we wanted to see the formula, well, what do? We take the future value of the tax savings. How to calculate that is you take the tax savings times the future value factor. Here you see the math right there. But if we were to work this by hand, we take the tax savings we've calculated from above, that's given in cell I10, and then we have to find the future value factor where the interest rate is 7% and N is 6%. Now that may look small for you, but I've got it up here where you can see it as well. So let me put this on the main screen here. Oh, I guess I got to bring this to the front. There we go. Now I brought it to the front. So we've got to find where 7% interest and the number of periods intercept, and that's right there at 1.501. So if I slide that out of the way, then I can put the 1.501 here, and to calculate the future value using the table approach, where we're using factors from a future value of a lump sum amount. Remember, this is not an annuity. There's not a steady stream of payments. This is just you deposit it now, what's the future value at some point in the future? So we multiply the tax savings times the future value factor. And we come up with 2401.60. Okay? That's this problem, everyone.